smartest, and we always do our bestest, so we stand up from the rest. Being small is the best size of all. Cause if you're tall, you gotta be on the ball. Cause when you don't fit into buildings, you might hit your head on ceilings, and you soon find yourself feeling that you might be better kneeling. Being small is the best size of all. Being small, like a fly on the wall.
All right, hello everyone. Webinar, and I think I'm going to have Corey popping in a second to say hello, because it's actually an IVA web event today. So hi there, Corey. Sorry, I insisted on putting on that video in the beginning, which probably confused you a bit, but I thought, hey, you need to fill the room up, right? So
it gives us something to look at. Otherwise, they're going to be looking at my dial or your dial, and they can probably do better than looking at that. So thanks, Paolo, and yes, good afternoon, everybody, and welcome to today's session. And we're delighted to bring you another masterclass in our webinar series for IVA, and delighted to have Paolo as our guest speaker for today's session. I know many of you are still sort of joining us at the moment, so we'll give everyone just a few more moments, but I am also conscious of time, and I appreciate that everyone's busy, and we need to sort of try and keep this on schedule. So what I might do is I might just sort of have just a brief few moments just to sort of quickly chat about IVA, and then I'll introduce Paolo in today's session while the audience is still joining us. So for those of you who don't know me, my name's Corey Vella. I'm the General Manager for Independent Vets of Australia, and again, thank you and welcome to today's session. We're delighted in being able to present our masterclass today. So for those of you who don't know us, who are IVA? Independent Vets of Australia. So we're essentially a cooperative of independent vet practices that support independence and comprehensive membership benefits. So IVA has members based right around the country. There's various shapes and sizes of practices, and IVA has, I guess, reach into all sort of practice, and this is both regionally and I guess metro locations as well around the country, which is great. So what IVA gives you access to is essentially numerous partnerships that allows you to leverage and continue to grow your business to new profitability levels and get owner satisfactions. We currently have over 80 practices that are part of IVA, and that allows us to, I guess, negotiate on the group's behalf, and gives you access to all the various partners that allow you to focus on the areas that are important to you. So some of these areas that we sort of look into from an IVA perspective and how we support practices. So we look at areas like ownership capabilities, team capabilities, overheads and savings, cost of goods and savings, revenue growth, collaboration support, training, coaching, and so on. They're kind of headlines, but we have partners and support in all of these sort of areas that allow you to touch your practice in whatever way you want to. And every practice is individual, and you have your own set goals and individual goals that you're looking to achieve. And what we do is come in with an open mindset and work on how we can support you to achieve your goals. They're not our goals, they're what you want to achieve. So if you want to hear more about that, please certainly reach out to myself. The link that we would have sent you for this webinar has our contact details and email addresses there, or you can jump onto our website with all the W's and then independentvetsofaustralia.com.au, and then you can access IVA through that way as well. You can pick up the old-fashioned telephone and call that way as well. That works too. So I'd like to introduce today Paolo, who many of you no doubt would know. If you don't, you probably heard of. And if you haven't heard of, you will certainly soon realise how special Paolo is to our audience, and how great his sessions have always been for IVA and certainly his clients as well. So along with his wife, Anne, they're the co-founders of APL Accountants. So both Anne and Paolo are vets, practiced for many, many years, and then sort of moved over and did further sort of studies into accountancy and business advisory areas as well. They're specialists in the areas. They specialise in veterinary health practices and specifically into that sort of space. Clearly, they've got expertise in the area. having the backgrounds that they do, which means they're a perfect fit for the veterinary industry, certainly from a finance sort of side. So Paolo runs, along with many of the hats that Paolo has, runs many masterclasses as well, and sessions for, sort of talking about sort of various business models and support, and is very targeted and with his specific insights into the veterinary business and what success looks like. And he above anyone else, certainly knows what that looks like. So today's masterclass is an interesting concept. So it talks about and how the view of each vet working for you or the practice can be and should be assessed as a standalone business, which is an interesting idea. And Paolo's got some pretty interesting insights into these separate business models for your individual vets that look into the practice. So Paolo, I'd like to hand it over to you, and thank you again for your time today. And we'll look forward to your session. Thank you.
Thanks a lot, Corey, and thanks a lot, RBA, for having me here. I'm hoping my sound's coming through all right. Corey, can you just confirm you can hear me all right?
Yes, all good.
Oh, cool, loud and clear. All right. So thanks a lot for having me here. Thanks to everyone for attending. I really like the fact that that Corey called me special. I don't know, but those of you that were into the webinar earlier and actually saw that little video we played in the beginning of the little dogs being run doing agility. Two of those people, obviously myself and my wife. And my wife actually runs a dachshund in agility trials, and he's called Strudel, and he's also special. So I don't know whether being called special is a compliment or not, but Strudel is special. All right, so we'll get into this now, and we're going to talk about the concept of business unit reporting. And there I put in the power of small, because we're going to break down the practice into something small, just like those little agility dogs you saw running at the beginning, and actually really drill down into some very, very interesting insights we've had into the veterinary industry doing this only over the last 6 months. So anything you're seeing here is no more than 6 months old and probably never really been tried before, and it's really funky and cool. So just for starters, and actually I want to encourage you guys to use the chat. Use the chat box, not the questions and answers. So if you signed into Zoom, normally you have to go to the 3 little dots which it says more, and then go to chat, and then go into that right now. And if you go into chat, you'll see there's a little drop down at the bottom that says all panelists or everyone. And if you want to make the chat more interactive, put it to everyone, not just the panelists. Otherwise, just myself and Corey will be able to see what you're saying. There you go. And Debbie's already answered. Okay, and answer the question. Yes. Okay. So I'd just like to know if you're a practice manager or an employee or a business owner. So if all of you guys that are there now, you can start typing in there. Don't be shy. I know there's more than one of you there. I can see who's attending. Yeah. Okay. We've got manager. We've got business owner. Okay. Good. So at least and an owner, right? So we've got managers and business owners. Good. And that also confirms to me that you know how to use the chat. So that's where you can put your questions, and you can hear me loud and clear. All right, so let's what I'm going to do is I'm going to do like a little spoiler here in the beginning, and I'm actually going to come back to the slide again at the end, and you'll understand it best when I come back to it in the end. But we'll start at the end, really, is what we'll do, just to give you a taste of what we're doing here. So here, this is actually stuff I've actually looked at in the last 3 weeks. We're in the throes of doing interim reporting for our clients. And what we're looking at here is a business unit report for the same individual, what happened in July to August, and now what's happened in October to December. And the only thing I really want you to take note of in this particular slide is that this particular employee or team member's performance was running at a minus $2,500 loss in the first quarter, and now in the subsequent quarter of this financial year, the second quarter of this financial year, is actually running at a profit of $22,000. Okay, and how this is calculated is going to be the purpose of this web event. But I'm sure you, and it seems predominantly practice managers and business owners that are on this particular event today, from your perspective, obviously, the first scenario is not a good scenario to have, because what's happening there is this is costing you as much as it is to insure a dachshund through pet plan, all right? So this is costing a lot of money. And can we change and train and mentor these younger vets to perform and improve their performance quite quickly so that they're actually a profitable business unit? And if there's anyone who is eventually going to watch a recording of this, or anyone in here who is actually an employee, we also need to assure a sustainable veterinary industry where people can actually run profitably, because certainly the first scenario, the table we're seeing on the left-hand side here, if that carried on forever, this would be a person who would not have a sustainable career in the veterinary industry. And as a business owner and manager, it's also our obligation to make sure that these younger vets can actually fend for themselves and have a career in veterinary science. So I think this is very, very important looking at this from both perspectives. All right, so I'd also like to say thank you very much for those of you guys, those of you who are attending. For everyone who's attending this web event, we are actually going to be providing a business loan to a woman in Malawi, and therefore in Malawi, creating a little business unit where a woman can sustain her family. This is being done through an online giving platform called B1G1, which we're strongly supportive of through APL accountants. And in fact, B1G1 have actually allowed us to create what they call a veterinary hive. So if anyone, APL clients or not, as long as you you are a vet or you own a veterinary business, please feel free to contact us if you want to get involved with this. It's something that we're using to, in terms of business units, help drive staff engagement and actually have impacts all over the world. So please feel free to ask us about that too, and thank you for attending. Okay. So this little picture here sort of reminds me, and I'm going to take a few steps back because I have been thinking over the last month or two where the veterinary industry was where I graduated and where it is now. And the fact that often the finger is pointed saying millennials and Gen Ys are very, very difficult to manage. But we have to accept, actually, I think it's more a case of a change in environment and the fact that the veterinary curriculum perhaps has not stressed financials enough. And this picture actually reminds me of myself when I first graduated as a vet. I graduated as a vet with an interest in wildlife game capture, African game capture. I knew nothing about money. The first job I took in the UK, I literally sat in the consult room and I did consults, pen and paper. There was no computer system. The receptionists used to actually do all my invoices for me. I didn't even know what an invoice was. And money was totally not important to me when I graduated. The practices ran very, very differently. There was this thing in the UK, I was practicing in the UK at that time, 10-minute consultations, open surgeries at the end of the day, and literally there'd be people queuing out of the door, even for a mediocre practice, just to have a consultation. So my job was predominantly reactive. Sick patients would come into me, and I would treat those patients. And whether or not I upsold or promoted additional services was irrelevant. That practice would make money because it was just very, very busy. Things have changed considerably in the veterinary industry over the last 20 years, and the focus has gone very much more to wellness services. Trauma cases are much less. I mean, there's leash laws, dogs don't break their legs that much, etc. Things like Prevecto are stopping all the tick cases. So everything starts to move towards preventative medicine. And there's a lot more profitability in preventative medicine, but one key component changes in preventative medicine versus reactive medicine, and that is you have to believe in what you are promoting, and you have to promote that to the pet owner. And we can all appreciate that there's a lot more difficulty in promoting a dental to a pet owner than saying, the dog's leg is broken, let's fix it. Because to the pet owner, it's blatantly clear that a dog's leg is broken. It's not blatantly clear that that particular dog needs a dental. So performance and managing the performance of our team and helping and assisting and mentoring our team in achieving these objectives is becoming key to the veterinary industry. We cannot report and assess the way we used to 20 years ago because the veterinary industry will fail. And we can see it failing in its current environment unless we do something different. And this is our way of doing something different and looking at things slightly differently. All right, so let's go into the financial stuff now. And what I'm going to do now is, for those of you who want to DIY the stuff, you can by all means DIY the stuff. I'm going to give you all the information that you can actually produce business unit reports yourself. There'll be a recording of this web event. You'll be able to review the recording. Last time we presented something similar, I got heaps and heaps of emails, people asking me how to do it because they'd watched the video again and again. We encourage you to do this. We also offer this as a service through APL accountants. It's more automated, it's quicker. So if you want it done for you package, we can do it for you. But you will have all the information and all the ins and outs of how this works. It's actually not as complicated as it seems. All right, so here what I have here is just a little refresher on a very, very simple profit and loss statement. We have a profit and loss statement here over 91 days. It says at the top 91 days, so that's 1 quarter, 3 months for a smallish veterinary practice. And basic format of a profit and loss statement, they're making $192,000 in sales, so that's what they're getting paid for by their customers for veterinary services. And then from that $192,000, we subtract all the various expenses. So there's cost of goods sold, so obviously they're using materials, strip bags, antibiotics, etc. etc., external laboratory fees, things like that. So that's being used, and the practice has to pay for that. They have to pay vets wages. They're paying $45,000 in wages. They're paying support staff wages, so they're nurses and receptionists. They're paying $43,000 in support staff wages. Then they're paying operating expenses, which is like the electricity, telephone, software expenses, staff amenities, staff training, all those sort of things. So this is all the money that's going out. And then they're obviously paying rent because they're operating out of a facility. And those are all their main expenses. And once I subtract all the expenses from the $192,000, you can see that they've got an earnings before depreciation and interest of $10,800. Then on top of that, the business owner has to pay interest on any loans they've got in equipment, and they also have to account for their equipment that's degrading and slowly being used up and getting older, which is called depreciation. There's $5,800 of that, which then leaves a residual profit of $5,000. Now, if I take that $5,000 and I divide it by $192,000, it gives me 2.6%. And that's actually your profit margin. And that means that in this particular practice, for every $1 that a customer pays them, they've got 2.6 cents left as profit. And again, complete disclosure here, the figures I use, I don't make up. What we do is we use I tend to use real figures in my presentations, but we randomize them by about 5% either way. So the scenarios are totally real. This is irrecognizable as to which practice it is, but it is a true scenario, okay, of something I've probably done in the last 6 months. So this is what this veterinary practice looks like. But we have more than one vet working at this practice. And what we really want to do now is actually break up the puzzle here and say, okay, wouldn't it be really, really nice if this practice has got 2 vets working for it? To really know if these vets have got different strengths and weaknesses, and if there's ways we can manage these vets slightly differently, mentor them, coach them, so that they can perhaps make this practice a little bit more profitable. This practice is running at a sub-average net profit margin by Australian standards. Most practices will be running at around, average would be running about 10% profit margin, so this one's below average, so perhaps we would want to improve their performance here. So let's break this practice up again, randomized figures, but a true scenario, into the 2 full-time vet equivalents that work at this practice. And then, so these are the actual results, and then I'll show you how we do this. Okay, so here we can see that there's 2 team members. There's 2 vets working at this practice. They're not full-time vets. There's one team member who's working as a 0.4 full-time vet equivalent. Sorry, slide popped up. Let's just go back. Working as a 0.4 full-time vet equivalent. In other words, they worked for 200 hours over that last quarter. So over 3 months, they worked for 200 hours. And the other team member worked as almost a full-time vet equivalent, having worked about 484 hours over that particular quarter. And if we break down the profit and loss, break down the profit and loss for these 2 particular individuals, and I'll briefly tell you how we do this, and I'll go over it again because it's so important. We can see the one that worked as just under a half full-time vet equivalent generated about $70,000 in sales. The one who worked there more generated $122,000 in sales. Now this we get from the practice management software. There's no way you're going to get this from your accounting software, okay? Your bookkeeper cannot code the revenue generated by each vet into a profit and loss statement. So effectively all you do is you get it out of your practice management system and see how much revenue each vet generated exclusive of GST over that period. Okay, it's quite simple to do, a bit of a manual task, but very, very doable. Then the other stuff you can get from a profit and loss statement, because this is stuff that the bookkeeper codes. And then we break up the cost of goods sold. That is apportioned according to the percentage of sales that the vet does. So basically, if they sell more or they do more services with clients, they're obviously going to be using more materials. And if they do less work, they'll be using less materials. So we allocate the cost of goods sold, external laboratory fees, drugs and purchases and things like that, according to their volume of sales. And you can see here, this one did less work. So they got $15,000 of cost of goods sold allocated. This one got $25,000 of cost of goods sold. Their wages, we know. We just pull up a payroll summary and see what we paid them over the quarter. And in this particular case here, we paid this one $15,000 and we paid this one $30,000. Then we allocate the support staff wages according to the time that they've worked. So this one worked 200 hours, this one worked 484 hours. So we allocate the support staff wages based on the hours worked. We allocate the operating expenses in exactly the same way based on the hours worked. We allocate the rent in exactly the same way based on the hours worked. And with that, we have everything to calculate the EBITDA, earnings before interest, tax, and depreciation for these 2 vets. And we can see here, in this case, the half-time vet generated about $11,000 of profit, or was running at an EBITDA of about 15.71%, a profit margin of 13.14%. So roughly speaking, on par with the average veterinary practice, whereas the full-time vet equivalent here was actually minus $200, so give or take at break even. So this particular vet unit is not generating any profit for the business at all. Okay, and that's the basis of business unit reporting. It's quite simple when you look at it that way. It is very manual, and obviously if you had 6 vets, you'd have to do it 6 times. And we have software. We actually do it automatically, and we run a whole lot of software in a practice where we do this for our clients. But the concept is pretty sound. So I'll go through those things again with you here on this chart here, where I actually look at the full-time vet equivalent, the 484-hour vet, and go through how we allocate that all again and how it works. And from the commercial standpoint, I would ask myself, if I was a person who owned a veterinary premises that was fully fitted out and ready to operate as a veterinary clinic, and that's all I owned, and my business was to put vets in there who worked as independent units with their own ABNs and operated in such a business, how would I allocate the cost of my facility and support staff to these vets? So I'm supplying them everything. I'm supplying them nurses, receptionists, x-ray machines, access to a wholesaler. How would I allocate these expenses? And this is commercially how it would be done in such an environment. The revenue is the revenue they generate, so they keep all the money that they generate. Then looking at the cost of goods sold, I allocate the cost of goods sold according to the volume of sales, because cost of goods sold is a variable cost, and in our experience, it very, very predictably increases in the same proportion as your sales. So that's allocated as a proportion of sales. The wage is the actual wage paid to the veterinarian. The support staff wages are allocated according to the vet's hours. So if they're spending more time in the practice versus other vets, they're using more of the nursing time, they're using more of the receptionist time. So that's how the support staff get allocated. Operating expenses in the same way, they're using more electricity, they're drinking more of the coffee and staff amenities. The wear and tear on the building they put on the building is based on the hours they work there. That's fair. And then the rent again is allocated, if I was a landlord, based on the amount of time that particular person spends there, just like a parking garage, and the car's occupying a certain space for a certain amount of time. That's the amount of money that it pays. And that's a very, very sound way of breaking up or allocating the various expenses. And with that, we can produce a profit and loss statement for each individual vet. And I can assure you, from multi-vet practices, this analysis is a real eye-opener. As I say, we've only started doing it in the last 6 months, but it's very, very easy to identify individuals who are having difficulty with certain aspects of veterinary practice, and to then enable you to coach them and get them to perform profitably and sustainably for their veterinary future. So I think this is a very, very powerful tool. Okay, one of the things I did want to highlight here is, please be aware when you're looking at the hours you're allocating to an individual, you're looking at the hours they are working as a vet, okay, not other stuff. So 2 examples here. If you have an older vet that spends 40% of their time mentoring younger vets in your practice, then that 40% time mentoring is a support staff role, and you don't include those hours, okay? So that's one of the catches here. You have to be aware of the time management of your team and what they're doing. And on the other hand, if you have another vet who you make responsible for a degree of marketing work and administrative work, and if they're spending 20% of their time doing administrative work and 80% of their time doing veterinary work, that 20% time administrative work, they are a support staff member, and those hours don't get counted in this particular analysis, and therefore the expenses and the overheads do not get allocated for those hours. They are support staff, all right? So remember that. That's very, very important, because it does change the analysis quite a lot. Okay, so I'm getting one question here. Where are the other wage components put, such as payroll tax? For this particular, so that's Debbie asking that, so I'll just answer that one quickly now. Generally, when we look at stuff like payroll tax, we would normally just allocate that in operating expenses. That's generally how we benchmark a practice, and then that would be allocated across the various team members based on the hours they work. There's no hard and fast way to that, because not every practice pays payroll tax, but generally when we do our benchmarking for veterinary practices, payroll tax is actually allocated. Well, it depends what we're doing. I don't want to overcomplicate things. If we're valuing a practice, we leave payroll tax in. Very often when we're doing this kind of analysis, if we're using the software, we would probably eliminate payroll tax from the performance metrics, because we would like to make sure that we're scoring small practices and large practices the same. If you were doing it in your own practice, I would say from a profitability perspective, you should probably want to account for it somewhere. So you'd put it in, I would put it in operating expenses. I don't think it would alter the analysis very much. Okay, with that, so some insights we've come up with, again, having done that and having looked at that particular analysis across that particular practice with those particular vets. One of the things that we'd heard a lot of and scratched our heads a lot over was the sort of very, very common sort of rule of thumb, where is it reasonable to assume that if a vet can generate 5 times their wage, they will be profitable? This is something that goes around a lot, you know, the sort of very famous 5 times wage multiplier. So, you know, if I'm paying someone $20,000 in a quarter as a wage, then they should be generating $100,000 in revenue. And then if that happens, I can assume they'll be profitable. And although obviously it's a useful rule, there's no doubt that it's a useful rule, we have found quite a lot of scenarios where actually that doesn't hold true. And I'll show you some of these scenarios straight away, and I'll show you why it doesn't work. So here we've got a good example again. It's actually, it's the same, similar practice. So here, I'll carry on using this practice. Actually, this is another analysis I did for a practice, randomized but a true scenario, where we're looking at a scenario where we have a new graduate, we have an experienced vet, and what would happen if we replace them with a new graduate. And this is the kind of the scenarios we have seen quite a lot now when we've been doing interim reporting. Is we know that in this case, so team member 2 here is an experienced vet, earning $122,000. Their cost of goods sold have been allocated according to their hours, etc. And we can see in this particular instance, they're running at a minus $200, sort of roughly break even. So this is actually that team member 2 that we had in the previous example. And now if we were to replace them with a new graduate, we could pay a new graduate half that. Like we could pay them $15,000 a quarter. We're looking at a period of 91 days, so we could pay them $15,000 per quarter. But that new graduate will never generate the same revenue as an experienced vet. We know this to be true, right? They'll probably generate around $90,000 in revenue, which we can see from a wage multiplier perspective. We're paying them $15,000, they're generating $90,000. They've got a 6 times earnings over wage, so they're doing a 6 times wage multiplier in revenue. Whereas the experienced vet was doing a 4 times multiplier, right? But when we allocate all the other stuff as per the way we said we would do it, so we allocate the cost of goods sold according to their sales. So their cost of goods sold is definitely going to be lower because they're generating less, they're using less materials. Their wage is a statement of fact. We know what we're paying them. We're paying the other one $30,000. We're paying this one $15,000. Support staff wages, they're doing the same hours in the practice, so they get allocated the same amount of support staff wage. And in this case, I would say to a new graduate, we're being fairly kind because we know that they need more mentoring and more looking after, and often take up some time of the senior vets. The operating expenses, in spite of them being a new graduate, if they're spending a certain amount of time in the practice, they're being allocated the same amount of operating expenses. And if it's a high overhead practice and it's got high rent, they'll be allocated, because they're in there for the same amount of hours, the same amount of rent. And you can see in this particular scenario that the new graduate with a 6 times wage multiplier is performing even worse than the experienced vet that only got a 4 times wage multiplier. And the scenario we're looking at here is we have a new graduate in a high overheads practice, a practice that's got expensive equipment and an expensive facility and pays their support staff a good wage. Then that new graduate is likely to struggle to generate enough revenue to cover their overhead expenses. Sure, they can take a really, really low wage, but they still can't generate enough revenue to cover the overheads expenses. And again, scenarios we've seen now, it's not rubbish data, it's not made up. This is certainly the kind of thing we've seen. And this is where it brings me back to the first part of the web event, where I was saying it's really up to us now to start coaching younger vets in that particular role, where veterinary medicine has really moved to a preventative role, and where you're no longer a reactive vet, where you were just treating trauma cases and profit was a given, to someone who has to promote wellness services, has to believe in wellness services. Otherwise, you're going to really, really struggle to keep a sustainable veterinary career, or certainly from the team member's perspective, you're going to be stuck on that $15,000 wage forever. that's the best you're ever going to do unless you can improve those particular skills. So if we want to keep younger vets in the profession, really as business owners, it's up to us to mentor them to be able to generate more revenue through wellness services. Otherwise, they will never be able to, afford a mortgage, buy a car, have children, etc., etc. It's just not sustainable from what we're seeing here. And again, the point being here also, don't only rely on the wage multiplier. It's a rule of thumb, but it's not necessarily accurate. Okay, then the other thing I want to just highlight here is we've looked at the financial status and the financial generation of the various vets in the veterinary business. But we kind of ignore certain things, and here we kind of label people. I know we shouldn't label people, but these are two really nice labels. And again, taking those two vets we were speaking about earlier, we have to acknowledge that there are people in a veterinary practice who might be doing a lot more consulting work, and as a result, booking in a lot more procedures, but not actually invoicing those procedures. If their job or their role is primarily in the consult room, then the procedures are going to be handed off to another vet in the business. And that vet who actually does the dental procedure or does the x-ray procedure or does the general anesthetic will be invoicing it under their own name. And if you're thinking back to our profit and loss statement that we were looking at earlier, remember we're measuring the revenue for each vet from the practice management system. So the person invoicing the procedure is the person who's going to be allocated that revenue. But we have to allocate some kind of acknowledgement to the people who book those procedures in. Now, I'm going to, again, disclosure here, the other stuff you can do by hand, this is really, really hard to do by hand. We have software that does this for us, and we call this conversions. All right, so here in this example I'm showing you here is, I'm just going to look at the top two lines, the dental's invoice versus the dental's converted. The dental's invoice is quite simple. It's the person who raises the invoice. The name of the vet that shows up on that invoice is where your practice management system is going to allocate the revenue for that particular person. But from a conversion perspective, we need to work out who booked that dental in. Now, we have software that does this for us. We actually look at the most recent client-facing event and like the most recent consultation, and then allocate the kudos of that dental procedure to the person who did the most recent consultation with that client. It can be done by hand, but it's quite a manual task. And we can see in this occasion, and this does happen occasionally in practice, not every practice. In fact, in most practices, I'd say 8 out of 10 practices, the conversions and the invoice actually match up fairly closely. But in about 20% of practices, we have a big disparity between conversions and invoiced. And in this particular case, we can see here that team member 1 invoiced 20 dentals, but only converted 10. Whereas team member 2 converted, invoiced only 10 and converted 20. So team member 2 only did 10 of the dentals, but actually booked in 20 of them. And we call that person who has a high conversion rate, we call them a pet advocate. And then we have members in the practice who don't convert particularly well, but get through a lot of work and invoice a lot of sort of prep room and operating theatre work, and we call those workhorses. Okay, the workhorses get allocated more revenue. The pet advocates, we have to acknowledge that if they're converting a lot, we have to say, okay, there is an inherent value to them. Okay, and just again, both of these individuals are very, very high value to a practice. You need pet advocates in the consulting room who are good at converting. You need workhorses who can get through a lot of work, and we see high value in practices to both these roles. Okay, and having identified these strengths and weaknesses in a particular individual can actually allow you to manage the time. And workhorse is often a person who likes to do all the work in the back and is very good at it, and a pet advocate is a person who likes speaking to people and good at consulting. So you can actually get people to work to their strengths. So there is a lot of advantage in also doing this, and this is part of the analysis we also do when we do the financial business unit reporting, because I think this is quite important. So remember that at the back of your mind if you're just looking at the financial reporting. All right, so keeping on with the same example with this new graduate versus the experienced vet here. We're looking at this new graduate now. They had $90,000 revenue. They were running at a $14,200 loss. So how are we going to correct this? And this is actually a slide I showed before we'd actually done another case study, which I'm going to show you at the end now. And I would say, well, okay, we saw earlier on that they converted more dentals than average. What's the hidden value of this? We can actually kind of work out in our head what the hidden value of this is. And their average invoice value, if we're looking at other metrics like average invoice value, was $20 lower than what it normally is in the practice. what happens if we can correct that by just half? In other words, by $10 per invoice? Because it's quite common for younger graduates. If I think back to how I was when I first graduated, where I showed that picture of that little girl with the glasses and very confused about money, I probably wasn't invoicing very accurately when I first came into practice. So what if we can correct those two things? And we can see straight away here that, you know, the 10 dentals that were converted, if we say, well, roughly $800 per dental, which is roughly what a dental procedure goes out at in Australia. And we know the profitability is pretty high because you're not putting on more staff to do that dental procedure. So we know the profit's about there's already around $6,400 in profit. It's already almost half the shortfall in that loss, almost half that $14,000 loss is soaked up by the fact that this person was actually a pet advocate and could convert dentals. Then we look at their invoicing and we correct their invoicing, coach their invoicing, get the nurses to help them with their invoicing. And we know that a vet generally raises about 600 invoices per quarter. And if we multiply that by 10, then well, there's another $6,000 profit. So straight away, we can see we've almost brought this new graduate now to break-even point, and we can do this fairly quickly. Now, when I did this presentation 3 months ago, I had the slide, and these two red things at the bottom are not real data, right? I made them up. Okay, this is the things I would look at correcting in a new graduate. Now we actually have a scenario here that I'm going to show you with real randomized data, true scenario. You won't be able to identify the individuals involved, but that's a slide I showed you at the beginning of this web event. And this is true, okay? There's no lies here, nothing hidden. This is a young graduate working in a high overhead practice. We had the meeting with the business owner 3 months ago, and the chart on the left is how they were performing. Their revenue was $75,000. They weren't working as long. They were doing 345 hours over the quarter in that practice. They increased their hours to 530 hours, but that doesn't change the performance because the overhead expenses are allocated based on the hours they spend in the practice. In the first quarter, they generated $75,000 of revenue. In the second quarter, they generated $130,000 of revenue. So we could argue, yeah, they spent more hours in the practice. Yes, they generated more revenue. Their cost of goods sold, however, is allocated based on their volume of sales as a percentage of their sales. So their cost of goods sold was only $16,000 when they were a poor performer, and now it's $28,000 because they did a lot more work. They used more drugs. They used more, more external laboratory fees. They used more of that stuff. Their wages were $14,000 3 months ago. They're still being paid $14,000 now. They haven't got a raise yet. The support staff wages allocated when they were a poor performer was $21,000. They get a lot more support staff wage allocated to them now because it's based on their hours, and their hours increased. Their operating expenses allocated were $20,000 3 months ago. They're now $28,000 because they're using much more of the facility, more repairs and maintenance, more wear and tear, drinking more of the staff amenities, coffee, all that sort of stuff is happening. And the rent has gone up. It was $6,500. Now I'm a landlord. They're using much more of the parking space. So it's been allocated to $8,000 there. But in spite of the higher allocation and high hours they've spent there, you can see that they actually ran at a profit of $22,000 or an EBITDA of $22,000, which is at 16.92, which is at national average, just in one quarter. Okay, so you can see straight away here, the chart on the left, a young vet who does not have a sustainable future. The chart on the right, a young vet who does have a sustainable future. And my approach with this young vet now is, great, you are now, you've gone from being not being able to sustain yourself in a veterinary career to being sustainable in an average veterinary practice. But remember, you have an average here, and your wage is only $14,000 a year, a quarter. Like, do you want to be the cheapest vet on the block and carry on charging $14,000 a quarter as a vet? Or do you want to be the best vet on the block that can command a wage of $120,000? And just like you are as a business owner running your veterinary practice, we know we all don't want to be the cheapest veterinary practice on the block. We don't want to be the discounting practice. Well, this vet shouldn't want to be the discounting vet. I don't want to be the cheap vet. I want to be the best vet. And to be the best vet now, to move from being a cheap vet to the best vet, if we were to increase the wage here to $30,000 and still expect an average performance for the industry, obviously the revenue has to go up. And this is where the coaching has to go in, like how do we get our younger vets to believe and promote and be comfortable with promoting these wellness services that drive profitability in practice. And as a result, it's good for the business, it's good for the individual, whether they carry on working for you, whether they open up their own business eventually, or whether they progress to working at another practice. At least they're never going to be fighting against the current in terms of poor performance and profitability if we can coach them through this. So that's kind of the take-home message. This was actually, to me, quite rewarding from a financial perspective to see an immediate jump like this really, really quickly in individuals. And this is kind of where what we want to work towards with business unit reporting. And yeah, guys, carry on putting questions there. I'll answer all your questions as we get to the end of this presentation, which is pretty much now. You know, the reason why we've done it also, other industries report in this manner. It's nothing unusual. It's unusual for the veterinary profession. We have to do something different because our current veterinary profession is not sustainable. You know, if I was selling software and I had 2 software lines, I would identify the software that wasn't making me money. If I was selling cars, I would identify the car model that isn't making me money. But the problem and the complexity in veterinary practice is everything pivots around a single professional, a highly trained professional who makes recommendations. Hence, that is our business unit. And to me, that is the only way we can actually have business unit reporting in the veterinary industry. It's pointless reporting across product ranges. And the veterinary clinic has to become sustainable. Managers can focus. Historically, what we've done as an accounting firm and as a business advisory firm is, yes, we can see that this entire business under-promotes dentistry and under-promotes radiographs and maybe doesn't use you know, laboratory work as well as they should. But if we can focus in this manner, we don't only focus on the business, but we can actually identify disparities in individuals where the training required is actually different. Because you might have one individual that's good at promoting laboratory work and another individual that's good at promoting dentistry within the same practice. And if we can break it down to that level, we can drive profitability up exponentially, and we can coach younger vets to do better. And obviously identifying strengths and weaknesses in team members, which I showed you there with workhorses and patient advocates. You know, so there's a lot of advantage we can see in doing this, and I'm fairly convinced certainly we'll be doing this, quite a lot of this going forwards. So I can see questions have come in here. So there's one here coming in. What would be the average support staff % to income? Yeah, okay. Or vet hours, or to vet hours. Yeah, cool. Very good question there, Debbie. So when we do this analysis, and you'd have to kind of have a feel for it for your own practice. So when we do this analysis, it's really nice if a veterinary practice can break their payroll for support staff versus veterinary staff. But, you know, 8 out of 10 practices don't do that, and you don't have to. Because we know that a veterinary, probably about 8 out of 10 veterinary practices, the support staff and veterinary wage overhead is 50-50, almost identical. So for example, if a practice is paying $500,000 a year in wages, in 8 out of 10 practices, 250,000 of the wage will be vet's wages, and 250,000 of the wages will be support staff. So receptionists, nurses, etc., administration, that sort of stuff. So when we do the analysis, if it is a practice where we know, because we do their bookkeeping, we do a lot of stuff like that. If we know it's a practice that's 50-50 split vet to support staff, and when we do the wage allocation, we actually take the wages, the total wages, divide them in half, and then allocate that 50% of the wages to the staff, the individual staff member, based on their hours worked. Does that make sense, Debbie? I'm hoping it does. So we take half of the wage total and then allocate that to that particular individual. Notably also, if we're looking at wages in a veterinary practice, and this is something you'll want to do if you're doing it yourself with spreadsheets, is you have to also make sure that the wages in the profit and loss statement for your practice account for a commercial owner's wage. Because in many, many veterinary practices, obviously the owner might be working a 40-hour week, but may not be taking a wage out of the practice at all. So that wage for the owner has to be allocated. If they're working, say, a 40-hour week, then you have to add $100,000 to wages for that business owner. Okay, so you need an adjusted wages, and then we allocate, we use 50% of the adjusted wages for allocation as support staff. And, you know, then that gets split up based on the hours worked. Okay, so if there's any other questions, feel free, you can ask them now, or I'm sure Corey will supply and my email address in the post. I think you'll get an email after this web event. And more than happy to answer any of your questions around this. I think it's a powerful, powerful tool. You hopefully there'll be a recording. I know it's complicated, but you'll be able to go through it, and I can assure you, you will be able to work something out if you go through this. I've given you all the information you need, I think, and hopefully you enjoyed it. So, Corey, that's what I've got for you guys today, and back to you.
Thank you very much, Paolo. That was terrific, and it's very insightful to break it down in those sort of terms. It's an interesting way to view it and to put the numbers against individual performances. So it's I'm sure it's not something that people really look that closely into. So it's always a healthy thing to be able to look at these things and these kind of numbers and get to the crux of the performance, and particularly from a financial level of what individuals are doing within the business. So it's good, and I guess allows you to focus as well on areas of growth and support and coaching and so on and so on for certain individuals. So thank you so much, and thank you again for your energy levels today, and thank you again for being so special. There you go. There's that word again.
Special. I think my wife does tell me I'm special. I think she does. Oh, you are special.
Yeah, but when she says it, when I sort of say it, might be different. Might mean different things, though. But look, thanks very much, and to our audience, yes, we have recorded this. I know there were many people who were unable to meet to join us today, so we'll send out the recording to people that registered for the webinar, and those who wanted to sort of see it afterwards as well. We can certainly get it out to them, and certainly contact details will also be included in that. But certainly reach out to Paolo directly at APL Accountants for any further advice, and if you're not using APL and Paolo and Anne and their team, I certainly would strongly encourage you to have a think about it and have a conversation with the guys about what they might be able to do for your practice. So there's no question, APL has a long-standing partnership with IVA and its members, and it's highly valued. And the support that they give our members is terrific, and it's certainly something that is a highlight for many. So thank you, Paolo, and thank you, everyone, and enjoy the rest of the afternoon wherever you may be in the country, and have a good afternoon and take care. Thanks very much.
Thanks, Corey. Bye, everyone. Bye.